Are you tired of low returns on your investments and looking to spice up your portfolio with higher yields? Junk bonds might be the answer you've been searching for. But before you dive in, there are crucial things every investor must know to navigate this risky yet rewarding investment option. Hello, my name is John, and in this video, we're going to delve into the world of junk bonds. I'll walk you through what they are, how they work, and why they can be a lucrative opportunity for savvy investors. Stick around until the end, as I'll share essential tips on how to assess the risks, conduct due diligence, and make informed decisions when considering junk bonds for your investment portfolio. Junk bonds, also known as high-yield bonds, are debt securities issued by companies or governments with lower credit ratings compared to investment-grade bonds. These bonds offer higher yields to compensate investors for the increased risk of default. Despite their risky nature, junk bonds are an attractive investment option for those seeking higher returns in their portfolio. To understand junk bonds better, it's essential to know that they are considered riskier investments due to the higher likelihood of default by the issuer. Rating agencies such as Standard & Poor's and Moody's assign lower credit ratings to junk bonds, indicating a higher risk of default. Companies that issue junk bonds typically have higher debt levels, weaker financial positions, and limited operating histories. Junk bonds boast several key features that set them apart from traditional investment-grade bonds. One of the primary benefits of investing in junk bonds is the higher yields they offer compared to investment-grade bonds. Moreover, including junk bonds in a diversified investment portfolio can help spread risk across different asset classes. While junk bonds come with higher risk, they provide diversification benefits, especially when combined with lower-risk investments, potentially enhancing overall returns. Another key feature of junk bonds is the potential for capital appreciation over time. As the credit quality of the issuer improves, the value of junk bonds may increase, leading to potential capital appreciation for investors. This upside potential adds another dimension to the return profile of junk bonds. The junk bond market is less efficient than the investment-grade bond market, providing opportunities for skilled investors to identify mispriced securities and potentially generate alpha through active management. Overall, the advantages of junk bonds, including higher yields, diversification benefits, potential capital appreciation, priority liquidation, and market inefficiencies, make them an appealing option for investors seeking to enhance their portfolio returns. The history of junk bonds traces back to the 1980s when Michael Milken, a key figure at Drexel Burnham, pioneered the concept of high-yield debt instruments, popularly known as junk bonds. These bonds provided substantial sums of money to hostile bidders and leveraged buyout companies, enabling them to finance large-scale acquisitions. During the 1990s, junk bonds gained popularity as a financing tool for companies looking to raise capital outside the traditional banking system. However, the financial crisis of 2008 led to a decline in demand for junk bonds as investors grew concerned about the potential default risks associated with high-yield securities. In recent years, junk bonds have experienced a resurgence in popularity as investors seek higher returns in a low-interest rate environment. Despite their risky nature, junk bonds continue to attract investors looking to diversify their portfolios and capitalize on potential enhanced yields. Understanding the historical context of junk bonds provides valuable insights into their evolution and relevance in the modern financial landscape. Investing in junk bonds offers a unique set of advantages that differentiate them from traditional investment-grade bonds. Let's explore some of the key benefits of investing in junk bonds and why they might be an appealing option for investors seeking higher returns and portfolio diversification. One of the primary benefits of junk bonds is the higher yields they typically offer compared to investment-grade bonds. This higher yield potential is attractive to investors seeking to maximize returns and generate income from their investments. Including junk bonds in a diversified investment portfolio can help spread risk across different asset classes and provide diversification benefits. Combining higher-risk junk bonds with lower-risk investments can potentially enhance overall returns and reduce portfolio volatility. Another benefit of investing in junk bonds is the potential for capital appreciation over time. As the credit quality of the issuer improves and the value of junk bonds increases, investors have the opportunity for potential capital appreciation. adding value to their investment portfolio. In the event of default or bankruptcy, bondholders of junk bonds typically have priority over equity holders in the liquidation process. This means that bondholders may have a better chance of recovering their investment compared to stockholders, providing a level of protection for investors. While junk bonds offer a range of benefits, they also come with risks and drawbacks that investors need to consider before adding these instruments to their portfolios. Understanding the potential pitfalls associated with junk bonds is crucial for making informed investment decisions and managing risk effectively. One of the key drawbacks of junk bonds is the higher risk of default compared to investment-grade bonds. Junk bonds are issued by companies or governments with lower credit ratings, indicating a higher risk of default. In the event of default, bondholders may face the risk of losing a significant portion of their investment. Junk bonds are also more susceptible to market fluctuations and economic downturns compared to investment-grade bonds. The prices of junk bonds can be highly volatile, making them riskier investments, especially during periods of market instability. Moreover, junk bonds often come with higher fees, including underwriting fees, commissions, management fees, and additional costs that can eat into potential returns and reduce overall profitability. These higher fees can impact the attractiveness of junk bonds as an investment option. The junk bond market may also have lower liquidity compared to the investment-grade bond market, making it challenging for investors to buy or sell junk bonds at favorable prices, especially during times of market stress. Limited liquidity can affect the ability to exit positions quickly or efficiently. Junk bonds are sensitive to changes in interest rates, as rising interest rates can lead to a decline in the value of existing junk bonds, potentially resulting in losses for investors holding these securities. Interest rate sensitivity is a key risk factor that investors need to consider when investing in junk bonds. Lastly, junk bonds may not be suitable for all investors due to their higher risk profile. Investors with low risk tolerance seeking stable and predictable returns may find junk bonds too risky for their investment objectives. Understanding the disadvantages of junk bonds, including higher risk of default, increased volatility, higher fees, limited liquidity, interest rate sensitivity, and suitability considerations, is crucial for making informed investment decisions and managing risk in a portfolio that includes high junk bonds attract a diverse range of investors with varying investment objectives, risk tolerance levels, and financial goals. Let's explore some of the key categories of investors commonly attracted to junk bonds and why they might find these high-yield securities appealing for their portfolios. Institutional investors, such as pension funds, insurance companies, and hedge funds, are major players in the junk bond market. These sophisticated investors often have the resources and expertise to analyze and manage the risks associated with investing in high-yield bonds. Institutional investors are attracted to junk bonds for their potential higher returns and diversification benefits. High-net-worth individuals and families may also invest in junk bonds as part of their diversified investment portfolios. Wealthy investors are drawn to the higher yields offered by junk bonds, despite the increased risk of default, as they seek to maximize returns and generate income from their investments. Mutual funds and exchange-traded funds that focus on junk bonds provide individual investors with access to diversified portfolios of high-yield securities. These funds offer a convenient way for retail investors to invest in junk bonds without having to select and manage individual bond holdings. Risk-tolerant investors with a higher risk tolerance may be willing to take on the additional risk associated with junk bonds in exchange for the potential higher returns. These investors are comfortable with the volatility and credit risk inherent in high-yield securities and seek to capitalize on the enhanced yields offered by junk bonds. Speculative investors looking to capitalize on market inefficiencies and mispricings may also be attracted to junk bonds. These investors actively trade high-yield securities to generate short-term profits based on their market views and analysis of the junk bond market. Opportunistic investors view junk bonds as an opportunity to invest in distressed or turnaround situations with the potential for capital appreciation. These high-risk investors seek to profit from mispriced securities and undervalued companies in the high-yield bond market. Understanding the various categories of investors attracted to junk bonds and the reasons behind their investment decisions provides valuable insights for individuals considering adding junk bonds to their investment portfolios. By assessing their risk tolerance, investment objectives, and financial situation, investors can determine whether junk bonds are a suitable option for enhancing their portfolio returns and achieving their long-term financial goals. As we wrap up our discussion about junk bonds, I want to hear from you. Do you think junk bonds are right for you? What strategies will you implement to navigate the risks and potential rewards? Share your thoughts in the comments below. For more free and practical information on investing, check out the link in the video description for valuable resources and tools to help you make informed investment decisions. Don't forget to give this video a thumbs up if you found it helpful and subscribe to our channel for more insightful content on personal finance and investing. Thank you for watching and happy investing!